Vanguard's very, very ugly 10-year return projections. This is so ugly, we got to bust out the PVC pipe of knowledge. Now, with this said, Vanguard has been notoriously underwhelming in terms of their 10-year projections. I mean, literally for 10 years. I try to, I was I got so much crap I've downloaded and I never remember to title it. But I should have looked at the Wayback Machine, but I probably should have. But I can't remember what they said in 2014, 2015, 2013. I just don't recall. And I had some links saved in my bookmarks, and they were just, goes to what a 404 or something like that, where the web page is done now. Anyway, at some point it's a broken clock and all that stuff, I would think. But this is the worst it's ever been, in my opinion. And I'm just like, damn, Vanguard, you're really... you're really pessimistic. No other way around it. Now, in some regard, I almost wonder if it's somewhat self-serving. All right, so Vanguard is notorious for low fees, and so if the returns are going to be low, the one thing you don't want to do is lose a lot of the low returns to your fees. All right, let's just say you get a 1% return, and you're paying your financial guy 1%. You're paying Vanguard 5 basis points. So inherently, your financial guy is going to give you 0. And Vanguard is going to give you 95 basis points as a return. So that, somewhat maybe self-serving to say we expect low returns, which means we're kind of propping ourselves up. I don't know. I'm not going to go there, but I'll show you on the chart here. So check this out. So this is from Dateline. Do they have a date on here? As of January 23rd, 2025. All right. A hawkish Fed is unlikely to cut policy rates target below 3.75 to 4% range. Yeah, I completely agree. Don't expect interest rates to drop, which means if you bought bonds, almost 2 years ago now, like I did, long-term bonds, you're not going to get that big jump like you had thought. I thought we were going to get a big jump in performance because interest rates would fall. They a little bit, but not much. And as such, you're just riding those interests that you're getting, which is pretty good. I mean, I'll take 3, I'll take 4 or 5. Actually, what is my EDV doing? Let's take a look at the EDV. Yeah, here's the, I own this, so you probably should not own it, as Marie said in a live stream today when I was doing it with, Amar. She goes, I do the opposite of what Josh does. Yep, as you should. What's this guy? Right, so right now it's paying 4.84, all right? So that's, I'll collect that. Every single month is 4.484 over the course of a 30-day SEC yield, but I'll freaking take that. Don't forget, I got a course, by the way, on investing. It's in the show notes, so I'd never advertise. I should. If you want to know just basics on investing, in terms of you're like, I'm not quite sure, it's okay. I got a course on that down below, so sign up for it. Frankly, I can't remember how much it cost. I just don't recall, but definitely sign up for my course on that. Anyway, so here's EDV getting 4.84. It's let's see what the performance has been. All right, so here's the returns over the last 10 years. Negative 3.63% a year. 3 years, and I've only had it for 2. So the last year is down 9. Over the 2 years I've had it, it's probably down 14% or something like that. So I'm just getting crushed there. Good stuff, good stuff. Don't listen to me. But anyway, so we're not going to see a rate cut anytime soon. It's just not happening. Full-year economic growth should remain above 2%, a view that accounts for potential changes to trade and immigration policy. However, higher-level tariffs risk restricting growth and increasing inflation. Okay. I mean, this is just so trite. Oh, tariffs restrict growth and increase inflation. Wait till I show you the book I'm reading by my man Douglas Irwin. And he's, I don't want to say anti-tariff guy. He comes across it, but it's just, okay, whatever. It's very frustrating to me. All right, anyway. The headwinds could be stronger in China with a spotlight on degree of policy support offered and potential U.S. tariffs. Okay, so here we go. So U.S. equities, return projection, 2.8 to 4.8. Global equities, 6.9 to 8.9. We'll get it on the white chart here in just a second. Value stocks. So let's just say this is going to be 3.8 for U.S. equities, 7.9 for global stocks. That's ex-U.S. So global is ex-U.S. So Vanguard has an ETF, VXUS. That means all global stocks minus the United States. So it's not just, it's global X the United States. You don't want world, which includes the United States. U.S. value, 5.2. Growth, what is that? 1% on growth. We're going to see here large. Yeah, so growth, that's what we're talking about. All right, then we're going to have fixed income. Aggregate bonds, about, what's that, about 4.8. Treasury bonds, about 4.6. Cash about 3.5 and inflation about 2.5 or so, 2.6, something like that. So let's look at this right here. So we had inflation at about 2.45 for inflation. We're going to take U.S. equities. Our nominal return, nominal is before inflation, is 3.8. Subtract your inflation, your real return is 1.65%. 1.35%. You factor in volatility of basically a 17% standard deviation. You got a lot of up and downs to get a real return of 1.35. A lot of volatility. That means up and down, by the way. No, I mean down and up, by the way, too. So that could be significant on the upside, but it could be significant on the downside as well. Value stocks, they expect a 5.2% return. Subtract the 2.45% inflation, and it's 2.75 is your real return, with a 19% volatility. So again, if you're going to go value, according to Vanguard, you're only going to walk with a 2.75 rate of return, and you have massive volatility. Can you handle that? Probably not. Growth, they're expecting a 1% rate of return. With an inflation of 2.45, they're expecting a negative 1.5% real return in growth stocks. Negative 1.45. That's what. So basically, if you want to beat inflation, you would avoid growth stocks according to the Vanguard model, and that will have volatility of 17.8. That's crazy. International, they've been expecting international for a long, long time as Vanguard. They've been wrong. You're going to get a 7.9% nominal return minus inflation, basically 5.5 with 18.5% volatility. All right. Here's where I find it interesting. Treasuries, they're expecting to give us better rates of return on treasuries than growth and just U.S. equities as a whole. They're expecting treasuries to give us a better rate of return than U.S. equities as a whole. So subtract out inflation, your real return on treasuries, 2.15, which is bordering up against value stocks, and is better, significantly better than U.S. equities as a whole, and significantly better than growth stocks. All right, so if Vanguard's right, you'll want to be in treasuries. Do I expect Vanguard to be right? We'll get in that here in just a sec. And then finally, we got cash. 3.6 is what they're expecting on cash, minus inflation, 1.15%. Look at this. Treasuries have a third of their volatility as stocks do, and yet they're expecting to do more. So if Vanguard's right, Treasury is going to take off relative to stocks with a third of the volatility. Cash will give you 1.15, which is still almost as good as U.S. stocks, much better than growth stocks with, what's that, a tenth of the volatility. So what do I use this in my projections? No, I'm still using 6%. I don't see that stocks are going to be that bad. I just don't believe it's going to be that bad. Now, Vanguard would make an argument valuations are too high, and I'm not going to get that video here because I'm going to do another video on that later. They'll make an argument that tariffs, all that stuff. Look, man, have we ever had a decade where stocks only gave us 3.8%? The only real decade we'll talk about this, the only real decade we'd have was the aughts. All right, not even the 1930s, it was the aughts. In the aughts, we had a return of zero, it was negative 1% a year. Maybe the 1930s, but then you factor in deflation, which not inflation, but deflation, you weren't only getting a 1.35% rate of return. You're doing better than that. And the aughts is the only decade, now I'm not talking 10-year time frames, I'm talking decades, 1930 to 1939, 2000, 2009. The aughts are the only time we had a return of an S&P 500 that had a negative real return. And that was only 15 years ago. So then you got to say, well, are we likely to get that again, given that we just had it 10 years ago, 15 years ago, 20 years ago? And I don't think so. I mean, that's a very low rate of return for stocks. I mean, hell, 3.8% rate of return, we're getting about 1.5% right now in dividends alone. So all we have to do is get just regular earnings growth. That's 6%. We're going to be fine. So anyway, that may not happen. I still use 6% as my rate of return on U.S. equities. 6%. That's a nominal rate of return. I'm still using a 3% inflation. So my nominal rate of return on U.S. equities is still 3%, just FYI. I'm giving treasuries a 4% rate of return. I'm not quite following the 4.6. That seems a little bit high to me. But be it as it may, and with a 3% inflation. So treasuries, I'm giving a nominal rate of return of 1. All right. So if you're still using right capital, or I'm still pretty pessimistic. Not that pessimistic though. That just seems a little bit absurd. All right, love your thoughts. Smash that like button. God bless. We'll see you.